WorldCom, the $11 billion accounting fraud hook. WorldCom inflated profits by $11 billion using one simple accounting decision. They took ordinary operating expenses and recorded them as long-term investments. Between 1999 and 2002, this accounting shift transformed declining performance into the illusion of stability. No complex derivatives, no exotic financial engineering, just classification. How does moving a cost from one line to another inflate profits by billions? To understand that, we need to examine growth pressure, executive incentives, and one of the most structurally important fraud cases in modern corporate history. Context: the rise of WorldCom. During the 1990s, telecommunications was booming. The internet was commercialized. Long-distance phone traffic surged. Fiber optic networks expanded rapidly. WorldCom did not grow slowly. It grew through acquisition. Under CEO Bernard Ebbers, the company aggressively purchased competitors. Its largest deal came in 1998 with the acquisition of MCI. At the time, it was one of the largest mergers in U.S. history. By the early 2000s, WorldCom had become the second largest long-distance telecommunications company in the United States. Revenue growth became the expectation. Wall Street rewarded expansion. Quarterly earnings targets became rigid benchmarks. Missing expectations meant stock price declines. Stock price declines threatened executive compensation. And falling stock prices threatened access to capital. Growth was no longer optional. It was mandatory. The accounting distinction. To understand the fraud, we must understand one fundamental accounting rule: operating expenses versus capital expenditures. Operating expenses are routine costs required to run the business day to day. They reduce profit immediately. Capital expenditures are investments in long-term assets. Their cost is spread over time through depreciation. The classification matters enormously. If you record a cost as an operating expense, profits fall now. If you record it as a capital expenditure, profits appear higher in the short term. The underlying cash may not change, but reported earnings do, and earnings drive valuation. The fraud mechanism. WorldCom faced rising line costs. Line costs were fees paid to other telecommunications companies for using their networks. These were routine operating expenses. As the telecom bubble began deflating in the early 2000s, revenue growth slowed. Competition intensified. Margins tightened. Meeting Wall Street expectations became increasingly difficult. Instead of reporting declining earnings, senior management approved a different approach. Billions of dollars in line costs were reclassified. Expenses that should have reduced profit immediately were instead recorded as capital investments. This single accounting decision removed expenses from the income statement. Profits appeared stronger. Margins appeared stable. Cash flow looked healthier than it truly was. Between 1999 and 2002, approximately $11 billion in expenses were improperly capitalized. The mechanism was simple. The impact was enormous. The pressure environment. Accounting fraud rarely begins with complexity. It begins with pressure. WorldCom had built its identity around continuous growth. Acquisitions had driven expansion. Debt had financed scale. When organic growth slowed, the financial model became fragile. Declining earnings would have triggered stock price collapse, credit downgrades, reduced executive compensation, loss of investor confidence. Short-term stability became more important than transparency, and once classification manipulation begins, it tends to compound. Each quarter requires another adjustment to maintain the illusion. Discovery. The fraud was uncovered internally. Cynthia Cooper, WorldCom's internal audit director, initiated an investigation after noticing unusual capital expenditure patterns. Her team examined entries within capital accounts. They discovered large transfers from line cost expense accounts into capital accounts. These entries lacked supporting documentation. They lacked economic justification. They lacked operational logic. The deeper they examined the accounts, the clearer the distortion became. Eventually, the findings were presented to the board's audit committee. The magnitude was staggering. Billions in improperly classified expenses. Collapse. In June 2002, WorldCom announced that it had overstated earnings by $3.8 billion. Further investigation expanded the total to approximately $11 billion. Investor confidence collapsed immediately. The stock price fell sharply. Credit markets withdrew support. Liquidity evaporated. In July 2002, WorldCom filed for Chapter 11 bankruptcy protection. At the time, it was the largest bankruptcy in United States history. More than 17,000 employees lost their jobs. Investors suffered massive losses. The growth story had been an accounting construction. Regulatory aftermath. WorldCom's collapse came during a broader crisis of corporate trust. Enron had already failed. Tyco was under scrutiny. Accounting integrity was being questioned across markets. In response, Congress passed the Sarbanes-Oxley Act in 2002. The law strengthened corporate governance requirements. It imposed stricter internal control standards. It increased executive accountability for financial statements. CEO and CFO certifications became mandatory. Internal control audits became more rigorous. The era of discretionary accounting latitude narrowed significantly. Structural lesson. WorldCom demonstrates a fundamental financial principle. Classification shapes perception. Perception shapes valuation. Valuation shapes incentives. When incentives reward short-term stability over transparency, manipulation becomes tempting. The fraud was not driven by innovation. It was driven by pressure. The reclassification of operating expenses into capital expenditures shows how small accounting decisions can distort financial reality at massive scale. Integrity of classification is integrity of profit. Without it, reported growth becomes an illusion, and illusions eventually collapse.